Hello students, in this class we have three parts. Okay, the first one is solving problems from chapter 3.1. This is actually the in-class problems. Okay, in-class problems chapter 3.1. So this in-class problems chapter 3.1, we have had three problems. We have already solved the first problems. Okay, and today we will be solving the other two problems from 3.1. Then we will be discussing the uh, different ratios and what are the importance of uh, those ratios, and then we will be solving chapter 3 2 in class problems. Okay, so let's start. So this is the second problem from our chapter 3.1. In this problem we can see that the balance sheet classification. We have already discussed the different types of assets and liabilities that we usually uh, record in our balance sheet. Say the this problem is related to that one. So the following are the typical classifications used in a balance sheet. Okay, so the current assets, this is A. We mark this one as an A. So B, investments and funds. C, property, plant and equipment. D, intangible assets. E, other assets. F is current liability. G means long-term liabilities. H, paid in capital. I, retained earnings. So for the following balance sheet items, use the letters above to indicate the appropriate classification category. If the item is contra account, please use a minus sign. See that if it is a contra account, say for example depreciation, then allowance for uncollectible accounts. So let's start. The first one, say that equipment. So what is that? What is equipment? So we can say, okay, I'm writing over here. So equipment, current assets. Is it current assets? No. This is a property, plant and equipment. Okay, you got it? So this one is C. Then accounts payable. What is accounts payable? So see that accounts payable is current liabilities. Current, correct? So this is an F. F. Okay. Then we have allowance for uncollectible accounts. This is a contra asset. So what we need to do, we need to use a minus sign before A, current assets. It means that this is a contra current assets. Okay. Then we have land held for investments. Okay. What is that? This one is an investment and funds. So this one is gonna be B. Note payable due in 5 years. Can you see that it's a long-term liability? Okay. So what should we do? We should use G. Okay. This is a G. Then deferred rent revenue for the next 12 months. Okay. So the number 6. This is deferred rent revenue for the next 12 months. So it's gonna be an F. Can you see that? Current liabilities. So we need to pay this one within the next 12 months. So that is why it's an F. Okay. Then note payable. Just guess what would be the answer. Note payable due in 6 months. It's very simple. This one is gonna be current liabilities. Income less dividends accumulated. What is that one? Okay. See, this one is retained earnings, income less dividend. So this one is going to be I. We know that from net income, when we subtract revenue, dividend, we found the retained earnings. Can you see that? So this one will help you. So net income, dividend. Okay. So this one, different colors. Okay. Font style, size, what do you do? Okay, let's use a different color. Okay, So investment in XYZ company, long-term investments. So what is that one? So let's see. This one is investment and funds. So it's gonna be B, inventories. So current assets A, correct. Then patent. Patent would be C, intangible assets. It's a D. Then land in use. Land in use. It's gonna be a C, that is property, plant and equipment, and accrued liabilities. So it's gonna be an F, that is current liabilities. Okay. Then prepaid rent for the next 9 months. So it's gonna be an asset. So that is current assets. A, common stock, that is gonna be paid in capital, that is capital, common stock. Okay, so common stock is gonna be H. Okay, then building in use. So building in use is C, that is property, plant and equipment. Cash, definitely it's an A, current assets. And taxes payable, this is an F, current liabilities. Okay, I hope you got it. Okay, so if you have any question, please let me know. We can discuss more. So this one. So here, let's solve the problem number 3 from the problem set 3-1, meaning the uh, problem set 1 of uh, in-class problems from the chapter 3. Okay, so here we can see that we need to prepare a balance sheet. Okay, here is the problem. So the problem is saying that the following is a December 31st, 2018 post-closing trial balance for Jackson Corporation, and we have the cash, accounts receivable, blah blah blah, then retained earnings, and finally the two sides, debit and credit sides, have balance. Okay, 403,000 each. And now the requirement is prepare a classified balance sheet for Jackson Corporation on December 31st, 2018. Okay, so here we have taken an Excel file. Okay, here it is. So let's start to solve the problem. So the first one is, so the first one I am just marking this one. So the first one would be, let me mark this one. So the first one is, okay, this one. So the first one is the assets. Okay, so here the first types of assets is the current assets. Okay, so what we are going to do here, just different colors. Okay, and let me use, okay, this color, okay, as current assets. So we can see that we have cash, accounts receivable, inventories. Okay, let's start with cash, that is 40,000. Okay, you can see that. So then the second one is the accounts receivable, which is accounts receivable is 34,000. Then we have marketable securities. Okay, and the marketable securities is okay, let me see. And here we have the marketable securities. Okay, this one. Okay, which is 10,000. Okay. So 10,000 marketable securities. Then we have inventories. Okay, we have inventories, that is you can see that 75,000, which is also a current assets. Okay, and we have another current assets, that is prepaid rent for the next 8 months. See, this should be used within next year, next 12 months. So that is why it's prepaid rent. Okay, prepaid rent is current assets. Okay, so now what we can do, this is our total current total current assets. That should be equal to, we can use the auto sum, but what I'm doing here, see, this one plus this. Okay, this is a total current assets. Okay, so I'm just giving it a different color. So let me see what color. Okay, this is one color. Okay, use, and then property plant and equipment. Okay, and okay, this is gonna be our different types of assets, so that is why I'm using a different color. Okay, so property plant and equipment. Now we can see the machinery, and there is also depreciation, okay, on the machinery. Okay, so let's see machinery. So I'm not sure whether you can see this one. Okay, this should be easy. Okay, and our machinery is 145,000. Okay, and then less accumulated depreciation on the machinery, and that is, I'm writing the depreciation within bracket so that it becomes a negative value. Okay, and that one is 11,000. Okay, sorry, yes, we can use that. Okay, so 11,000 bracket close. Okay, so it becomes something like that, and then I'm using an underline. Okay, so the difference between these two would be our net property plant and equipment. Net property plant and equipment. So that should be equal to, so it should be equal to this one plus this one, because I'm using the plus sign because it has a minus one. So plus minus minus. Okay, so this one is the net property plant and equipment. Okay, so I'm also giving this one a color. So these are assets. Okay, and we have another type of asset, that is intangible assets. So I'm giving this one a different color. So the same color we have used. Okay, I think bold will be much useful. We can see this one easily. So we have an intangible assets. Can you see that? That is the patent net of amortization. Meaning we have already subtracted the amortization. Amortization is something like a depreciation. Okay, so that is patent. So the patent is 83,000. Okay, so this is also an asset. So we are using the same color for all the assets. Okay, and now I'm using the underline, and let's sum all of these. Auto sum, we can use the auto sum. Okay, this one is our total assets. Okay, so total assets. Okay, we have the total assets, and now we can use so let me mark and center. Okay, so this is our liabilities and shareholders equity. Okay, this is the liabilities and shareholders equity. I'm giving this one a different color. How? Let's use this. This color. How about this one? Okay. Okay, this one is color. Okay. So now, what are the liabilities and shareholders' equity? So the first one is current liabilities. The current liabilities. Okay, let's use a different color for the liabilities. I am using the red color one. Okay, so current liabilities. Let's see what are the current liabilities we have. So see, accounts payable, wages payable, taxes payable. See that bonds payable, this one is due in 10 years. So this one is not our current liabilities. Okay, so it's very simple now for us. So accounts payable we have. So let's see. Also this one is gonna be 8,000. Then wages payable, we have wages payable, that is 4,000. Okay, okay, so wages payable, and then we have taxes payable. Okay, and the taxes payable is 32,000. You can see that the taxes payable is 32,000. Okay, and then do we have any other current liabilities? Hopefully no, there is no other current liability. It should be 32,000. Okay, so I'm using the underline and then auto sum. We can do the auto sum over here. Okay, so that is 44,000 is our total current liabilities. Total current liabilities. Okay, so this is our total current liabilities. Now we have long-term liabilities. Okay, we have long-term liabilities, that is going to be, okay, I'm using the red color again and the bold, so we can easily see this one. Let me just, okay, it's better now. Okay, so okay, long-term liabilities, what we have, see, we have this one, see, bonds payable, that is due in 10 years. This is gonna be our long-term liabilities. Okay, so I'm writing this one. So bonds payable. Okay, that is 200,000. Okay, so that is our. So we have, so far we have our total liabilities. That is sum of these two. 244,000. This is the total liabilities. Okay, and now we can write total liabilities is this one, and now shareholders equity. Okay, shareholders equity, that's going to be let's make it red and italic and bold, so it's easy for us to view. And we have common stock, which is see the common stock 100,000. So we can use the inner column. Common stock is 100,000. Let's use dollar sign. So common stock, and then we have retained earnings, that is 48,000. Okay, so underline this one, and sum of these two should be here. It should be this one plus this one, and then the common stock and the retained earnings. So again, I mean the underline, and the sum of these two would be, okay. How about this one? Oh no, it's not working. So sum of these two, let's see how it calculates. No, why? So no, I'm using this one again. Okay, this one plus this one. Okay, now 392,000. This is our total shareholders equity. Equity, and this is gonna be our total liabilities and shareholders equity. So total liabilities and shareholders equity. Okay, so we have this one. Let me use the double line. Okay, and total assets, we should use the double line. This is actually closing. So this is, let's use how about this one? This one plus this one. Okay, so we have equal amount of assets and liabilities and owners equity. Okay, so this is how we prepare the, see that this is how we prepare. Okay, let me use this one. So okay, we can see the entire balance sheet in it. Okay, so you can see the current assets, property, plant and equipment, intangible assets. Okay, so total assets we have this one 392,000, and then shareholders equity we have liabilities and shareholders equity. So we have current liabilities, then long-term liabilities, the shareholders equity, and total we have 392,000 total liabilities and shareholders equity. So this is how we prepare the classified balance sheet based on these problems. Okay, so thank you so much. So again, welcome. So in this section, we will be discussing the usefulness of financial statement information. So you know that the companies are publishing their financial statements, the income statement, the balance sheet. So the income statement, the balance sheet, okay, and the say owner's equity statement. Okay, all of these statements are usually published through different uh, national newspapers, and they have to submit those financial statements, meaning the annual report or quarterly report, through the SEC, Securities and Exchange Commission, EDGAR. So so that the investors and other users can use those information to make their decisions. So the users are most interested in the outlook for the futures. So that is why if the investors or the other users want to make some decisions, they need historical information, which is which are the financial statements. Okay, so investors are interested in the default risk and the operational risk. Okay, so the risk, the company that may not be able to pay its obligations, that is called default risk. You know that many companies become bankrupt because they cannot pay the debt, their obligations. And the operational risk means it is related to the how a company can withstand various events, whether the company can run the operations, whether the company can pay the employee's salary. Those are the things. So that is related to the operations. Okay, and the financial statement analysis that is usually done by the interested parties, for example the potential investors, the creditors. Okay, they usually use the financial statements for their analysis. And you know, there are different types of analysis they do. The number one is the comparative financial statements, and the number two is the horizontal analysis, and the vertical analysis. Final one is the ratio analysis. So we are interested to know some ratios. Let's go there. So the first one is the liquidity ratio. So the liquidity means the readiness of assets to be converted to cash. So how much liquid assets we have in comparison to the current liabilities. Okay, So for that we have two important ratios. The first one is the current ratio, and the second one is the acid test ratio, or commonly it is called the quick ratio. Okay, so the current ratio is equal to the current assets divided by current liabilities, and the acid test ratio is calculated by dividing the quick assets by the current liabilities. And so they are actually very useful because they help you to understand the company's ability to pay the short-term obligations, meaning the current liabilities. Okay, so these ratios provide information about a company's ability to pay its short-term obligations. Okay, and let's see an example of current ratio. So this is an example from the Nike. So we can see that the Nike's current ratio is 2.52. That is really very good. It means that we have more than 2 times current assets than the current liabilities. So this is really good one. And the working capital, you know, the working capital is equal to current assets minus current liabilities. So the difference between current assets and current liabilities is the working capital. Okay, and the acid test ratio, it excludes the inventory, prepaid items, restricted cash, and deferred taxes. So when we will be calculating the quick assets, we need to subtract the inventories, prepaid items, and restricted cash. So the example of a Nike's one is the asset test ratio is equal to quick asset divided by current liability. So that is equal to 1.47. That is also very good. These ratios, see that are these ratios adequate? It is saying. So the industry average is, see, the current ratio is 1.41 and the acid test ratio industry average is 1.12. Whereas Nike has 2.52 in comparison to 1.41, and acid test ratio in 1.47 in comparison to 1.12. It means that Nike's financial position is really good. Okay, so the second one, solvency ratios. It means that how much solvent we are. So if we have more liabilities than the stockholders equity, it means that we have a problem in solvency. Or if we have more fixed expense commitment than our net income, then we have solvency problems. Okay, so the first one is debt equity ratio, which is equal to total liabilities divided by shareholders equity, and the in times interest earned ratio is, see, net income plus interest expense plus income taxes divided by interest expense. Okay, so and here are some examples. See, the debt equity ratio of Nike again is 0.7, and whereas industry average is 0.95. So Nike's debt to equity ratio, so Nike has a lower default risk because the industry average is 0.95, whereas Nike has 0.70. Okay, and the interest times interest earned ratio in case of Nike, it is 124.68, which is really good enough. Okay, and let's go to problem solving. So here we have problem set 2 from the chapter 3, and this is the problem number 3 of the problem set 2. You can see that's problem 3 2. It means that chapter 3 problem set 2, and this is the problem number 3. Okay, in this problem, so we are given a balance sheet on December 31st, 2018. So we can see that this is the total liabilities and equity. Okay, and we are also given an income statement. So the net income over here. So we can see, and from these we are required to calculate the current ratio, asset test ratio, debt to equity ratio, times interest earned ratio, and the return on shareholders equity ratio. So let's go to the solutions. So the first one here, you can see the current ratio is equal to, so current assets divided by current liabilities. So the first we need to know the current assets. Okay, so the current assets we have given are the, let's see, cash, that is 19,000. Then we have non-trade receivables, so non-trade receivables, and that is 35,000. Then we have accounts receivables, that is 48,400. Then the final current assets we have, that is merchandise inventory. Okay, inventory you have, so we have 70,600 inventory. So let's make it underline. Okay, and so this is the total current assets. Okay, and let me just insert new row. Okay, so and current liabilities. So we have total current liabilities of, see that from here current liabilities, it is given actually, there is no breakdown in accounts payable or something like that, but it is already given the total current liabilities, that is this amount. So let me use another underline, and here it is. So 8,000. Okay, and so the current ratio would be equal to current. Let me see right over here. So let me write, so total current assets. Okay, so it should be C. So total current assets divided by total current liabilities. So that is equal to 1.06, 1.60 actually. No, not this one. So let me make it about this one. Okay, it is good. Okay, so we have this one, and this is the current ratio we have, and then quick assets here. Number 2 is the acid test ratio, which is actually the quick assets divided by current liabilities. So quick assets doesn't include the inventory. It just excludes the inventory from the current assets. So we can easily have, so we can say quick assets is equal to, what is that? So this one, meaning cash plus non-trade receivables plus accounts receivable, these three. Okay, this is the total quick assets, and we already have current liabilities, and that is 108,000. So quick ratio would be equal to quick assets divided by current liabilities. So that is 0.94. Okay, which is also good from our previous example we have seen. So debt to equity ratio. So here we have to calculate the total liabilities and shareholders equity. So from here, debt to equity. So we need to calculate the total liabilities. So let's see the total liabilities. What we have now. See, so we have current liabilities, that is 108,000, and bonds payable that is it is saying long term, so that is 100,000. So we have, this is our total, this is our total liabilities. Okay, so let's use the auto sum. So this is our total liabilities, and shareholders equity, we need to know the shareholders equity, and the shareholders equity total would be, so the paid in capital or common stock. So paid in capital, so the paid in capital is 70,000, the first one, and we have the retained earnings, okay, which is equal to 157,000. Okay, sorry, 157,000. Okay, so this is our, okay, so what we can do, we can auto sum this one as well. Okay, this is our total equity, you can say. Okay, and now debt to equity ratio would be equal to, see what we see, total liabilities and shareholders equity. So we have total liabilities of this one 208,000 divided by total equity, okay, which is equal to 0. Okay, let me use a dollar sign before this one. Okay, and this one should be right. So it's equal to this one divided by this. This should be equal to, so it is giving me error because I am dividing this dollar amount divided by a number, so it is giving me dollar. Okay, so we need to use 70,000, correct? So this one is 70,000. Okay. Oh no, it's not taking the. No. Let me format the cell. So that is currency. Okay. Okay. Now here you go. So this is gonna be. Let's use the auto sum again. But let's use the currency. Okay. So let's see. So this one means total liabilities divided by total equity. So again it is saying, showing dollar sign, but it is not correct. It should just be a number. Okay, 0.92. Okay. Oh, okay. What we can do, so we can format. Let's format this one. So let's use this one as a number. Okay. Okay. Now here you go. So this is our debt to equity ratio. Okay. So the number 4 is times interest earned ratio, and for this one, what we need to do, we need to calculate the total interest, then net income. Okay, so let's start with net income. So total net income we have how much? So we have 73,008. Okay, 73,080. Then we have interest on income taxes. We have interest expense of 11,000. Okay, and then income taxes total we have 31,350. Okay, and now this one. So let's do the auto sum of this one. Auto sum. Okay, this one. Okay, and this one is the numerator. So total, and then we have interest expense of total 11,000. Okay, And now, so times interest earned ratio would be equal to, let's calculate the times interest earned. So this one, the total divided by the interest. So 10.49, that's very good. Okay, let's use the different color. Okay, so, and the return on shareholders equity, it's also easy. It means that how much net income we have in comparison to shareholders equity. Okay, so it should be net income divided by shareholders equity. Okay, so we have net income, which is equal to 73,080, and shareholders equity total, shareholders equity, we have total shareholders equity of, we have already calculated this one over here. So total equity 227,000. Okay, and that is 227,000. Okay, and now return on equity, that is return on shareholders equity, would be equal to net income divided by shareholders equity. Okay, that is also good. Sometimes many companies have different amount. Okay, so this is the total we have. So I hope you have understood how to calculate this one. Okay, if you have any question, please let me know.